I'm Ross Mould, AJ Bell's Investment Director. And in this latest edition of our regular Markets Review Breaking the Mould, I'm going to be looking at water, plumbing and groceries. All three of these topics look capable of causing a fuss in the week ahead because we have, in order, a first half trading statement from water utility United Utilities on Tuesday the 27th of September, full year results from specialist plumbing and heating equipment distributor Woolsey, also on Tuesday the 27th, and a second quarter trading statement from Sainsbury's on Wednesday the 28th. Let's start with United Utilities then. FTSE 100 stock due to release a trading statement ahead of its actual first half numbers that are due on the 23rd of November. As we can see here, the shares have slipped a little of late, largely because plump yielding so-called bond proxy stocks like water utilities have come under pressure owing to a sell-off in the bond market. That in turn, by the way, has been caused by investors' fears that bond yields have simply gone too low, especially if inflation starts to tick up. This next graphic shows United Utilities' share price against the yield on the 10-year UK government bond, or gilt, just so you can see what I'm on about. Anyway, to cut to the chase, if gilt yields go up, investors may switch to government bonds, as they can get better yields for less risk relative to a stock. As we can see here, there has been the odd lump and bump in United Utilities' dividend per share over the last decade, so there are risks involved. Even so, the stock offers a prospective yield north of 4%, a premium to the FTSE All share, so investors will be looking for reassurance that analyst dividend forecasts can be met. For the full year, the consensus is United Utilities' earnings per share will slip by around 5% to 45.4p, and the dividend rise by 5% to 40.4. That's enough for dividend cover of barely 1.1 times. When it comes to the trading statement, investors will therefore home in on comments on customer service metrics, especially after 2015's boil water notices in Lancashire, updates on leakage, and delivery of the £3.5 billion investment programme across the 2015 to 2020 regulatory framework. Also keep an eye on net debt. It has been creeping up, reaching 6.3 billion quid at the end of last year, although gearing does lie within boss Steve Mogford's 55 to 65% target range. On the same day as United Utilities statement, we'll get full year results from heating and plumbing merchant Woolsey, also a FTSE 100 member. After a wonky start to the year, the shares have rallied nicely as we can see here, and this seems to be for two reasons. First, Woolsey generates around 2/3 of its sales in the USA, so its earnings could get a boost from the pound's plunge against the dollar since June's EU referendum vote. And second, June's third quarter statement revealed a welcome improvement in like-for-like sales growth. The US grew 5% at constant exchange rates, while the UK still fell 0.4%, they were still the best figures of the year so far. Overall, group like-for-like sales growth ticked up a little bit to 2.8% as this graphic shows. For the full year, analysts are looking for pre-tax profit of around £862 million, growing to £995 million for the financial year just begun. And finally, we come to Sainsbury's and the food retailing sector, which received a bit of a lift early this month when Morrisons reported better than expected interims and raised its dividend. Now, no one should be too complacent here, as this is a very competitive business, as suggested by Ocado's recent profit warning. And Sainsbury's second quarter trading update on Wednesday the 28th could be instructive reading for the stock and the whole sector. The shares have tried to rally, encouraged by Morrisons and also Sainsbury's own June first quarter results, which were better than expected, even if they still showed a 0.8% drop in sales, excluding fuel on a like-for-like basis. Here's the share price, followed by the trend in like-for-like sales. Now the worrying bit is boss Mike Coop put the decent Q1 down to strong sales of football kit ahead of the European Championships tournament, at vinyl records and healthy growth in its online business. Now the last one sounds okay online, but the first two, you have to wonder how sustainable they would prove to be. In addition, data from Kantar World Panel shows that Sainsbury's is losing market share again, presumably to the discounters like Aldi and Lidl. So let's see if Coop can reassure on the top line, and also that his lunge to buy B&Q Owner Home Retail is the right strategy. Thank you for watching, and I look forward to seeing you next time.